Hey there, future financial pro. Welcome back to the channel where we dive deep into the fascinating world of hard to borrow stocks and potential short squeeze setups. Today, we're putting a spotlight on a biotechnology company that's been lighting up our screeners, VRAX Biolabs Group Limited, trading under the ticker VRAX. This is one you're going to want to pay close attention to. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Alright, let's talk about VRAX. VRAX Biolabs Group Limited is a healthcare and biotechnology company with a market cap of just $3.02 million. They focus on immune response detection, T-cell immune profiling, and developing in vitro diagnostic technologies for viral and immune-mediated diseases across the United Kingdom, the United States, and China. The product, VRAX Immune, is a key part of their offering. Looking at recent price action, VRAX has been quite active. Today, it's seen a slight dip of 0.25%, but zoom out a bit and you'll see it's up a significant plus 33.88% over the last 5 days. However, the last 30 days show a minus 13.86% decline. Volume-wise, today saw 983,800 shares traded, which is notably below its 30-day average volume of 2,682,018 shares, giving it a relative volume of about 0.4 times the average. Joe chart, VRAX price action over 5 days, then 30 days, then daily volume. What is cost to borrow and why it matters? So, what exactly is cost to borrow or CTB, and why do we care about it? Simply put, when you want to short a stock, you first have to borrow shares. The cost to borrow is the annualized fee, essentially an interest rate that short sellers pay to borrow those shares. Think of it like a loan interest rate you pay on money. The higher this fee, the more expensive and risky it becomes to hold a short position. When this number skyrockets, it's a huge red flag for short sellers because their holding costs can quickly eat into any potential profits, or even turn a winning trade into a losing one just by fees alone. These can exceed 100% annualized, meaning if you held the short for a full year, you'd pay more than the stock's value in fees. Why the stock is hard to borrow right now. Now let's bring it back to VRAX. This stock has appeared on our hard to borrow screener with some truly eye-popping numbers. The current cost to borrow fee for VRAX is a staggering 720.1% annualized. Just to put that in perspective, a typical healthy stock might have a CTB of 0.3% to 3%. A high CTB is anything above, say, 10–20%. At 720.1%, VRAX is in extreme territory. What's even more dramatic is the CTB momentum. It surged by an incredible plus 617 percentage points over just the last 5 trading days. This indicates an extremely rapid increase in demand and scarcity. Furthermore, there are only about 6,000 shares currently available to borrow, which is an incredibly small number, especially when you consider VRAX has an estimated float of just 0.8 million shares. Our internal composite squeeze score for VRAX, which combines CTB level, momentum, borrow supply, float size, and technicals, currently sits at a notable 59.7 out of 100. Squeeze mechanics explained. So, what does it mean when a stock like VRAX is hard to borrow? And how does a short squeeze work? A stock is hard to borrow when there are very few shares available from brokers for short sellers to lend. This scarcity drives up the cost to borrow. A short squeeze happens when the price of a heavily shorted stock begins to rise significantly. This puts pressure on short sellers, who start to incur substantial losses due to the rising price and the high cost to borrow. To limit their losses, or to avoid margin calls, they are forced to buy back shares to cover their short positions. This buying to cover creates additional buying pressure, which in turn pushes the stock price even higher, forcing more short sellers to cover, creating a powerful feedback loop. However, it's crucial to understand, a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have very strong conviction that the stock will eventually decline, and they are willing to pay a premium to maintain their short positions. Dilution risk check. Let's talk about dilution, which can be a significant factor in any short squeeze thesis. Dilution occurs when a company issues new shares, increasing the total number of outstanding shares. This dilutes the value of existing shares and can add supply to the market, which can often negate upward price pressure. For VRAX, we've checked for recent diluted SEC filings like SMINIS1s, SMINIS3s, or 424Bs in the last 90 days, and we found no recent diluted filings. This is a positive sign, as new share issuance could provide short sellers with an easy way to cover their positions, thereby stopping a squeeze in its tracks. Recent reverse split watch. Now, something else very important to note for VRAX: the company executed a 1/4-25 reverse stock split on June 26, 2024, which was just 17 days ago. A reverse split reduces the total number of outstanding shares and proportionally increases the price per share. In VRAX's case, 25 old shares became 1 new share. This effectively reduces the float, the number of shares readily available for trading. Historically, we've observed that many microcap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split, as the share count is reset and a new trading range is established. While this is a common pattern seen in some microcap names, it's absolutely not a guarantee, and investors should always proceed with caution. Show VRAX reverse split event on chart. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you keep an eye on if you're watching VRAX? Firstly, continue to monitor the cost to borrow fee and the number of shares available to borrow. Any further increases in CTB or significant decreases in borrowable shares could intensify the pressure. Secondly, watch the volume. A sudden surge in volume, especially on green days, can indicate increased buying interest. Thirdly, keep an eye on the price action itself. Look for VRAX to establish clear support levels and break through any overhead resistance. And finally, stay informed about any company news, especially from the biotechnology sector, that could impact VRAX's fundamentals. VRAX presents a fascinating case study in the world of hard-to-borrow stocks, with its incredibly high cost to borrow, extremely limited borrow supply, and the recent reverse split that has reset its float. While these factors create a compelling setup for potential volatility, remember that this is for educational purposes only, and investing always carries significant risk. Do your homework, understand the risks, and make informed decisions. If you found this breakdown of VRAX insightful, hit that like button, subscribe for more in-depth stock analysis, and let us know in the comments what other hard-to-borrow stocks you're watching. We love hearing from you.